The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is Esther Gulius, the Tax Lady, and we're asking you to join us on Ask the Tax Lady here on News Radio 930 WBEN, where we're going to go in depth to teach you some things about the tax laws that are changing so that you know what to do, so that you make the most out of every tax deduction that's out there and the changes that are in effect. Now, normally we take live phone-ins, but this week we're going to just answer emails so that we can go more in depth. And during the week, if you have any questions, you can call us at 632-7886 at our corporate office. We're open 9 to 5, Monday through Friday on Niagara Falls Boulevard. You can visit us online at egtax.com. Ask the tax lady. I'll answer any of your questions. But right now, I got Tiffany Fabian. Hey, Tiff.
Hey there, Esther.
And Christopher Fabian.
Hello, Esther.
And so what do you lovebirds got in store for today? What questions do we have?
I've got a question. It says, this is Martha from Depew. Dear EG Tax, help. I have been the legal guardian of a foster child for all of 2017, but I couldn't claim her because I don't have her social security number, and the county refuses to give it to me. Do you have any suggestions on how I could claim this child of mine?
Well, and under the change in the tax law, you have to have either the social security number or the taxpayer identification number in order to claim the child. So they won't work with you. You guys are aware of that, right?
Right.
So how do you handle this with your clients?
I would have done a paper return under the old law,
But this is the new law.
But this is the new law. So I guess get a tax ID number, right, Chris? Is that what
you can do a W-7, try to get a tax ID number, go down to Social Security, and try to have them help you get the Social Security number for the niece. But it's very interesting that the county won't release it.
But I had a client last year who has a
too.
foster child that's lived with her for 2 years, and they wouldn't give her
I've had that too.
Wouldn't give her the social security number. So I said, well, I'm going to put this return on hold. You go beat the bushes, see what you can do. She ended up putting enough pressure on the social worker that they gave her the social security number of the kid so that we could claim him now. Under the new tax law, it won't make any difference because she's not going to get the personal exemption. But she still would qualify if she's single to be head of the household, and she would get the new family credit, which is $500.
Yep.
So she doesn't get one, but she'd get the other. So it's very difficult. And really, I would like somebody to find out from Erie County why they won't let these people who are being wonderful to these children, why they won't give the Social Security numbers out for them.
Yeah, it's bewildering. It's just just crazy.
Okay, what else we got?
Tax lady, I am an over-the-road trucker, about 240 nights a year. Is it true that I can no longer claim my overnights as an expense against my income? Brett.
All right, Chris, you want to answer that?
As of right now, Brett, that is correct. If you are a W-2 employee, you cannot take your over the roads. You can't take your tools, your any expenses you have for driving the truck as an employee, you cannot take. If you're self-employed, you still can. So you got to see, are you getting a 1099 or are you getting a W-2? Because that changes the answer.
It is so interesting to me. I just can't believe that people are going to let this sit, that if you're self-employed, go right ahead. You can take your per diems. But if you're an employee, too bad, too sad. So this guy would be giving up about $12,240 in deductions,
That is
which is a lot of money, and if he's in the
Union.
22% bracket, that means it's costing him about $3,000 in taxes. That's a lot of money. We're suggesting that you go to the employer and you say, cut my salary by my expenses, so that if I was making 100, now I'm making 88,000, and then reimburse me 100% for my per diems. That would be the 12. I'm still making 100, but you're not going to be penalized for not taking the deduction as a miscellaneous itemized deduction. This way, it's a win-win for the employer. They get to take it. It's a win-win for you because you are being remunerated 100%. And the third thing is, which is a real bonus, is that you don't have to pay the FICA on that $12,000.
Yeah, and I can't tell you how many people I was sitting with doing their taxes this year for 17, and they're like, the word is still not out there. They're like, no,
I know.
I can't believe it. I can't deduct my union dues, my grooming standards. Go on, Chris.
I was just going to say, I can't believe unions aren't up in arms over this, because how many people do we have that pay union dues? And there's people who are in the carpentry unions or the electric who are paying $4,000 a year in union dues.
How about the stockbroker?
Yep.
Financial. I mean, let's face it. Tax prep is no longer deductible, but our fee's like $100, so you're losing $100, right? But the stockbroker, sometimes they're charging $14,000, $15,000, $10,000 for fees not deductible anymore.
Yep.
So it's really interesting. So those fees then would go to basis. So now you have to keep track of all that for the stock.
That's right.
Yep.
That's right, which is really important.
So there's more, but here's the thing, on the horizon, they're rolling out everything I read on this. They're rolling out these changes, and they're saying, oh, well, they didn't really mean this. And they didn't really mean this. And I know this is what they said, but they didn't mean this. And then the state of New York is also stuck between a rock and a hard place, because their personal standard deduction is $16,000 married filing a joint return. Well, since it's $24,000 married joint, there is this discrepancy between the standard deduction for the state and the itemized deduction on the federal. So there's a big thing that the state of New York has to deal with too. So they're saying that it will cost New York state taxpayers billions of extra dollars if they don't do something about it.
And I have clients who said, I mean, they got to keep their feet moving in the right direction. They said that they will leave the state, if there's not a correction made, So who knows?
It's easy to make threats, but when your job is here, and your family's here, it's really tough.
Yeah.
And I mean, we do different states returns, and how many, you look at Ohio or Pennsylvania, okay, they may not pay in a property tax for their house, but when they do their tax return, they got to pay a city tax, and then they got to pay a school tax based upon income. So the people who rent houses still have to pay a school tax. Right. So our taxes are a little bit higher here for that, but they're not getting it on the back end either. You're paying it all up front. I mean,
right. And then the other thing, like in Ohio, they don't let you exclude your pension that you get.
That's right.
So, so a lot of these states look, and again, Ohio has city tax and so when you partner that with your property taxes and your taxable pension, whereas on New York State, the first $20,000 you get on your pension is going to be tax-free on the state. If you're a city, state, or municipal employee, it's going to be 100% tax-free. So that's a Benny. So there are benefits to living in New York State, but right now this conundrum between the federal increased standard deduction and New York State standard deduction and itemizing is a big thing to reconcile.
Huge. And
what else we got, guys?
Well, we gotta take a break for some commercials, and we will be right back.
Hey, I'm Esther Gullius, the tax lady from EG Tax. Thanks for listening to Ask the Tax Question. It is Ask the Tax Question, but it's Ask the Tax Lady on News Radio 930 WBEN, and we're here with Tiffany Fabian, Christopher Fabian, and we're not taking live phone calls today. We are next week going to take your phone calls again, but we're kind of chewing up emails, and I think you'll find it to be very interesting because you can hear us think about the tax law, and of course with the most sweeping tax law changes that just took effect, we want to make sure you know what's going to come down the pike. And if you have any questions, you can go to our website or give us a call, and we're there to help you. So let's go. What do we got
I
next?
got Tom from Clarence who writes, EG Tax. So my kids are over the age you can claim them, but they are still costing a lot of money. The 20-year-old is in college, and the 18-year-old is just graduating from high school and plans to go to NCC this fall. Since you say we can't take any dependent deductions, are we just at the end?
Okay, actually, there's good news for this person.
Yep.
Because it is true. Once your child reaches 17, you lose $2,000, right? You're going to pay more than you're going to pay an extra $2,000 in taxes. However, once your child goes to higher learning institution, whether it be college or vocational school, anything that would qualify for a federal subsidy, then you're kind of back in the credit game again. And so they would get, for the first 4 years of higher education, whatever higher education would be, they can take credits of up to 20, well, actually with the state of New York rolled in, it's about $2,900 credits, federal and state. And so for each child, so for both of these children, they could get like almost $6,000 in savings.
Yep. So they'll get the AOTC credit, the American Opportunity Tax Credit, for
Assuming
the
they're
first
paying the tuition.
4 years. Yep. And then on New York State, they'll also get a college credit, assuming they're paying tuition. Because
so
there's
this
the
is
new-
not $6,000 in deductions. We're talking about $6,000 in money.
Right, as long as they have the income to back up the first
Right.
$3,000 of the credit, because that's the non-refundable credit.
Yeah. So at 17, you lose $2,000 per child. But once the kid is in college, then you would get the American Opportunity Tax Credit, which could be up to $2,900 or more per child for the first 4 years of continuing education.
Yeah.
Right, and the good news, good news for us as tax preparers, the IRS has made changes to that 1098-T, so they are actually going to be filling in now amount paid for tuition, not the amount billed. So hopefully that will eliminate a lot of letters from the IRS in New York State by having that box filled.
Yeah.
Right.
And then don't forget there's the opportunity of the free New York State, the Empire credit this year. So don't forget to explore that.
The Excelsior.
The Excelsior program. So don't forget to, I think for a married couple, the cutoff is like $113,000 that you would still qualify for some of that Excelsior credit. So make sure you explore that. I know Jeff Boron is a good resource at the Financial Guys. He's helped me out a few times during the tax year. So if you have questions about the Excelsior program, call us or call them, and we'd be happy to
And
help
Jeff
you.
Boron is a college planning specialist. And so, if you're looking for help with college, you want to talk and get all your ducks in a row. But one of the things I love about Jeff Boron is he's just a very pragmatic person, which I am too. He just thinks that you should not send your kid to a $30,000 a year college if the kid doesn't know what they want to do.
Right.
If this is, if Johnny is going to be a rocket scientist and this is his life lesson and he's doing really good and that's the place for him to go is over at this $30,000 a year college, well, that's one thing. But if Johnny doesn't know, why not use the community colleges? Because they're so much less expensive. The debt Johnny makes, he pays for after he's done with college. And you guys, you tell them what it's like to watch somebody struggle paying these student loans.
Oh, my God, the heartbreak, the stories. People are just barely paying the interest. They're not touching the principal.
That's right.
And it
Forever.
just-
I have 50-year-olds that are still paying student loans.
Yep. I mean, that leads into another email question from Lily. My husband and I have been filing separate to save money on our student loans.
There you go.
It seems like a good idea now, but is it really? Someone also told me something about getting them forgiven after 10 years of employment. Do you know anything about this as well?
Okay, this is so important. You know, I talk to people all the time about this. This is something people just don't get. If you work for a not-for-profit, like a hospital, if you work for the federal government, if you work in New York State, then after 10 years of you making faithful payments on your student loans, those can be forgiven, the
Right.
student loans.
Yep.
But you have to go down and apply for that, correct?
Yep. You have to make phone calls. You have to find out. You have to look into it. I know you have to be a full-time employee for a nonprofit agency. You can't be a part-time employee, but these are really good programs. And I know that, for instance, that email that you talked about, they're probably the reason that they're paying a reduced amount, they're probably doing income-based. And so a lot of those 10-year programs, you have to pay like your full amount, not just income-based. So you have to ask questions and make sure you do your due diligence when you're looking into this.
Right. Yep.
So why don't you reiterate about the 10-year forgiveness?
Sure. So if you work for a nonprofit agency, such as a school or a municipality or the county, any hospital, any non-for-profit agency, and if you work there full-time for 10 years and you apply for the non-for-profit student loan forgiveness, you can have whatever's remaining after that 10 years wiped away, gone, sayonara, see you later. You don't have to pay for it. And so that's a really important program, and you want to take advantage
But
of it.
until you apply,
The
your
10-year
payments are don't count, right?
Right. The 10 years doesn't start until you apply for
And so it's so important. So let's say that your kid just gets out of nursing school and they got a bunch of debt. They should apply right now at the hospital that they're working at,
Yep.
And
so
then
that it can be forgiven.
I also want to say about the Excelsior program before we forget, don't forget if you apply for that, you have to stay in New York State for 5 years and work here and not leave the state. So something important to take into consideration.
And if you
Well, you can leave, but if you leave,
You have to pay
it
back.
accelerates into a loan.
Right. You know, and going back to her original thing about filing separate to do the income-based repayments, you know, yeah, that sounds great now because you are saving the money, but all it's doing is pushing that debt to the back end, and it's just adding more and more interest. So where you think you're saving, it's actually costing you, like Esther said, where you see people with 50 years old still paying student loans because they do deferments, they do all this other things to get away from paying it, but student loans don't go away.
Can't roll them into a bankruptcy.
Okay, so so here's the thing: kids go into getting a job. If they're working for the government, if they're working for a high school, if they're working for many of the colleges are not for profit. Find out because don't just assume that they're not working for a not-for-profit. I never thought of Roswell as a not-for-profit, but it is,
Yep.
you know. So find out and then have them, they can call EG Tax, talk to Tiff or Chris or myself, and we'll help you to steer you in the right direction so that the student loans can be forgiven.
You know, and I've had some really smart parents out there where their kid is so much in debt, they said instead of going out and getting an apartment and living on your own, come back home for 3 years. Yeah, okay, you have to live with us again for 3 more years, but put the money right on the student loans. Get that paid off so
Smart.
that's not hanging over your head, because then you can go buy a house. You can go have a little bit of fun, and you don't have to worry about $50,000 to $100,000 of debt out there. You know?
Really being financially wise is not, it doesn't seem like a really fun thing, but when you have financial freedom as your career, as your life unfolds, It's unbelievable, as opposed to somebody just living from paycheck to paycheck. And if you lose your job, a calamity happens.
That's
Yeah.
right.
Okay, well, I think we beat that horse to death.
I've got no name. No name says, EG Tax, I have a business that has been in the family for 30 years. It's not an LLC or a corporation. I have 2 full-time employees, and I have all of my expenses. I have a profit of approximately $100,000 a year. The taxes are killing me. Any suggestions?
Okay, well, first of all, I think you should, this Mr. No Name, should move into an LLC. It's not hard to do. It's simple to do. When 30 years ago, our society didn't sue, or we're not sue happy, and didn't have all the attorneys on the TV every 5 minutes saying that if somebody
you
passes
suffer
gas
from
the
this?
wrong way,
Did
they're
you
going to
do
be
this?
sued. I mean, I would get the LLC. It won't change the way you file your return. It's still going to be on a Schedule C, but it adds a layer of protection. Would you guys agree with that?
Yeah, not to mention the fact that he has employees. I think an S Corp would be a good idea too.
Well, I mean, and that's the next thing, is to look at maybe changing the makeup of your business from self-employed, a limited liability company, to an S corp. There's definite benefits to it. But the next thing is, do you have pension plans?
Right.
Because a lot of times when you're a small business owner and you're out there beating the bushes and you're working hard trying to make money, you don't have time to meet with somebody to say, let's set up a pension plan, especially if you have part-time employees. He could do a solo 401k.
Right. And
Right?
we'll talk more about the pension plans available to him after the news. We'll be right back.
Hey, this is Esther Golias, the tax lady from EG Tax. We're not taking your calls today, but we are answering in depth a lot of the emails that we got. And we just, Chris and I and Tiff left you with a cliffhanger before the news about what this, our self-employed gentleman might do. And if you are a self-employed person and you have employees that don't qualify, or maybe it's just yourself, maybe you're a realtor, you could set up a solo 401k plan and put a lot of money away.
Yep. I had a guy this year who's an appraiser, and he does a solo 401k, and Mama Mia, the amount of money that it saved
Up to
him.
$53,000 you can put away. I
Yeah,
mean, that's,
$53,000 in a pension plan. And so our guy has now it's easy. I mean, for us to tell you should put away $53,000 when it's his $100,000 and he's got to pay his bills. But the whole thing is, if the plan is there and you have a very good year, maybe you'll make $200,000. Maybe you could set aside that money into your pension plan, which is then tax deductible and saves you a lot of money.
Yeah, in this.
So I
guy's-
guess Mr. No Name, I guess
Right.
people must know him if he's got no name. Mr. No Name should give us a call at our corporate headquarters at 632-7886. Visit us online at egtax.com, because I think he should set aside some Friday afternoon and sit down and look at what's available to him, because if you don't plan, life happens anyway.
Yep. In my client's situation where he was able to put all that money away, he had a death in the family and he inherited a lot of money. So I think, like Esther said, it's all about not making gut-wrenching quick decisions. It's all about planning and making a phone call and doing the right thing.
Right.
Yeah. But and then also he has 2 full-time employees. If he set up a simple, he could also have it so his employees could put money into a pension
Right, but then
plan.
he wouldn't do a 401k.
No.
So
Well,
a solo 401k.
or how
But
about-
if he did a simple, he could put, if I'm assuming he's over 50 years old, he could put more money than in a IRA, and he could also do a match for his employees and himself.
right. I mean, if Mr. No Name is married to Mrs. No Name, he could hire his wife and put money away in her pension, whatever
That's
type
true.
you're setting up, and do the match,
That's
which
true.
is helps bring down that profit.
Right.
Now you're their kids.
Okay. All right. What else we got?
I've got Marie from Buffalo. EG Tax this winter did it for us. We're looking to buy a second home.
Did it for all of us, Marie.
Somewhere warm. So what can I deduct if I get this second home? somewhere warm.
You tell Murray I can't do it.
Well, it used to be that you could deduct second property taxes on another house, but no longer under the tax reform can you do that, and you can't deduct the mortgage interest either.
The property
Up
taxes
to
are limited to
$10,000, but you
The
can't.
second home, you're not allowed to do the mortgage interest on a personal residence.
Now, that doesn't mean that it's $10,000 for just this second home. It means the whole shooting match, your estate taxes, sales taxes, and property taxes on all of your properties. And the whole mush together can't exceed $10,000. So I'll tell you what I would tell you, Murray.
Rent.
If you're going to go buy the second home and you are only able, because you're still working here in Western New York, and you're only able to use it X amount of days, rent it out. Turn it into rental property. You can use it 14 days or 10% of the time it's available for rent personally, and have it still retain its business deductibility, which would mean then you can deduct all the property taxes, the insurance, the upkeep, the travel to go down and take care of the property, the towels, the sheets, the linens, the bedding, the cable TV, everything that you're making available for the tenant to rent the property. And I will tell you, since I have property in Florida, the people that rent, especially you're getting seniors many times who are retired, are renting, you'll find them to be remarkable. They'll take care of your house like it's their own. So there really isn't the wear and tear of, like if you're renting to a bunch of college kids that are going to come in and have a big weekend in your house. So it's something to think about. This way you get the best of both worlds.
Right.
Yep,
Right.
and make sure you keep track of when you're down there, who, when it's rented, have the contracts, you got to save everything, keep a calendar. We're down there this week, rented it the next 10 weeks. We went down for another week, then rented it for, 3 or 4 more months and then sat vacant. You have to keep track of everything just in case they come knocking.
Right. But the bottom line is, this is a way, so let's say you have it rented for 200 days. Then you can use it either 14 days or 10% of the 200 days, whichever is greater. Well, 20 days is better than 14, so you could use it 20 days personally. And, you think about it, maybe you go down for 1 week and another week, and the third week there's 6 days, and maybe the 7th day you do painting and some repairs to the for the upkeep, which would then extend the number of days that it can be used, not personally, but for upkeep.
And then, when I heard Chris say keep track of, I thought he was going to say keep track of the basis, because I can't tell you how many people sell a second residence, excuse me, and it goes on a Schedule D, and so they don't have any records. They don't have any records of the new driveway they
Keeping track of everything is
the
important,
painting,
no matter what
the
it
new
is.
dishwasher. And so records are really, really key. Just like Esther said, no matter what you have, make sure you keep track of it, because we want to know what that basis is as it continues to grow,
Yep. Okay, what else we got?
Al writes in, my mother owed almost $3,000 this year. It doesn't make sense to me. She has a small pension of $700 a month plus her Social Security of $1,800 a month. She said she got lucky at the casino a couple times, but insists her losses equal her winnings. So how can she owe this much money?
This is one of the things I love to show my seniors that I'm doing a tax return for, about how the Social Security taxability makes you pay taxes on it because of gambling income. So even though on the right-hand side she had losses equal to her winnings on her left-hand side, they don't stop the Social Security then from becoming more taxable. So if her pension's $700 a month, he said, Chris?
Correct.
So that's $8,400. plus her Social Security. So if, let's say that she won 25,000 at the casino, that's 33,400. If she's single, that's more than, when she adds half of her Social Security to that, it's going to make her Social Security taxable, which even though she's itemizing on the right-hand side, it doesn't get rid of the taxability of the Social Security. So it's really important when you're a senior, understand that if you're gambling, your gambling winnings can cost you taxes.
Oh my, and not to mention, I know I had a couple clients this year and they admitted, I have a problem. I go way too much, but their winnings were over $100,000. Their losses were just as equal, so we were able to itemize. But as seniors, what it's doing is, for Medicare, the last couple years,
and that's true too.
right? Their Medicare is going to go up
Yep,
drastically,
And they lose their STAR program.
and then they lose their STAR program and
Good
any
point.
other, maybe their Epic. You got to be really careful. If your parents, Al, you might want to sit down with Mom and say, Mom, we got to be careful. Let's cut back. I know it may be her enjoyment, but get her an iPad and let her
That's
play.
right. Let her play games at home.
That's right.
Esther, Chris.
What?
Oh, I love to play
Oh,
games.
so does Christopher.
But I don't never gamble.
Don't gamble.
No.
I don't gamble,
No, and
but
that's
I
why
love
I
to play
said get
games.
the iPad. Download her a couple slots.
And those people that play Bejeweled Blitz know
Oh,
that
you
I am
got
a
you
fierce
got to
competitor.
got to get the new HQ app, and we'll tell you about that later, Esther.
Okay.
It's a lot of
All
fun.
right, what else we got?
So I got Paul K from Buffalo. Esther, I can't afford to get health insurance. I make about $42,000. I'm single, but I support my 14-year-old son. Will I have a penalty for 18 for not having health insurance, or should I quickly try and go get some health insurance even though I can't afford it?
Chris, you want to answer that?
Well,
I don't think he's single, first of all. He's had a household.
okay. Well, either way, based upon his income, and there's two of them, it's unaffordable. So the exception to not having health insurance is there for him because of the unaffordability. So there would be no penalty for Paul. So you don't have to run out, but you may want to contact Karen or Tim at our office and run the numbers to see what you may be able to afford, because you would be surprised with the subsidies out there, or even changing your income just a little.
Getting
where
an IRA.
Getting an IRA or putting money in a 401k where it brings down your income, which increases the subsidy, or maybe let you be qualified for the essential plan.
And don't remind you also, if you've had a penalty for 2017, you should amend your return because of the unaffordability. You don't have to pay that penalty, so you should amend your return if you assessed yourself a penalty for 17
and
or
that,
16.
that's a really great point, Tiff. When we say there's no penalty, that doesn't mean that if you haven't had insurance that some fairy just waives the penalty. There's a form to fill out. Everything we talk about, believe me, there's a form for you to fill out. If you don't fill out the form, they're going to charge you the penalty.
Right.
The other thing you were talking about the subsidy. Don't be wishful thinking when you're filling out your health. You're applying for your health insurance with the New York State Department of Health, because if you say, "Oh, I think I'm only going to make 30," so they give you a bigger subsidy, and you make 50, you're going to be a very sad person because you're going to have to pay back the subsidy, and it's one big chunk of money.
It is. I had somebody this year had to pay back $13,000 because they sold a couple rental properties. And they
Yep,
didn't
and
let
capital
they
gains.
didn't
So,
let the
so
exchange
if you
show.
find your financial situation changing and you're on the New York State of Health, call them right away and stop the subsidy, because this money, some of this stuff is accruing at $1,000 a month. That's $12,000 that they just say at the end of the year, "Oh, well, you underestimated, then you owe us the money." And that can just really ruin a good day for you, I'll tell you that.
Ugh, yuck.
Yeah, any big balance due to
Right.
to the IRS.
Okay, what do we got?
Well, we will take our next question after our final break of the show. We'll see you on the other side.
Hey, this is Esther Golias, the tax lady. Thanks for listening. If you have any questions, we're answering emails today, so we're not taking live phone calls. But next week we'll be back with our live phone call segment. In the meantime, if you have questions, don't ask Aunt Millie. Ask us. Give us a call at our corporate headquarters, 632-7886. You're going to find everybody who wants to help you. Or visit our website at egtax.com. Ask the tax lady, and we will help you. So I'm here in studio with Tiffany Fabian, Christopher Fabian, and we're answering emails. And what do we got next?
I've got Arlene from Buffalo. Dear EG Tax, I received alimony in 17 in the amount of approximately $28,000, but I mistakenly claimed $1,850 because I got confused of the years when it started. Should I fix my return? And so
I think so.
Yeah, and
because what happens is your ex who's paying the alimony gets to deduct it. That's through 2018. And actually anybody that's under a pre-2018 divorce. It's going to be deductible to the payer, taxable to the recipient. So you're going to get a letter from the IRS with penalty and interest in the state of New York. So you want to be proactive and do it so that it minimizes the penalty that they're going to charge you.
Yeah. And I think right there, Esther said a lot of important things. 2019 divorces onward, the law is changing. And so no longer does a person who pays the alimony get that adjustment to income, and the recipient doesn't have to declare it as income.
Yes, so it ends up being like child support.
Right.
It's not taxable to the recipient and not deductible
If you're
to
the one
paid.
that's going to be paying the alimony, hurry up and get the divorce finalized.
Boy, ain't that the truth? You really want to get that thing done before 2019 because, I have dealt with parents, dads who are paying the alimony, and part of their ability to pay the alimony is predicated on the fact that it's deductible.
Yes.
Well, if it's not deductible and it's just tax-free to the recipient and not deductible to you, it can really make it difficult. And a lot of attorneys aren't aware of this. So you want to make sure that you educate your attorney so that they know, so that when they're doing the negotiation that you pay less because you won't be able to deduct it.
Right. Also, with the 80, I'm surprised how many attorneys don't know about the 8332
Right.
to claim the child that lives with the custodial parent, but it's your turn to claim the child.
And again, those are one of the things that we have to see how they're going to iron that all out, because if the 8332 waives the right for the custodial parent to claim the kid and you give it to the non-custodial parent, does that mean that the non-custodial parent gets the family credit, that new family credit?
Yeah,
right?
It's,
or does it stay with the custodial parent? Nobody's ironed that out yet.
Nope.
It's going to be interesting because in order to have a qualifying individual, there's going to have to be some form that's filled out.
Correct.
So,
Yep.
Okay, what else we got?
Okay. Jerry writes in, I knew my son was going to need braces one day, and that day is today. Can I use this as a medical write-off? What else can I use?
Yeah, I mean, you're going to find that it's more difficult to come up to the standard, over the standard deduction. Like if you're single, it's $12,000, but let's say those braces are $5,000, and the property taxes on your house and state withholding is $10,000. So now you're at $15,000. So you're already over the standard deduction. So medical is still deductible, minus 7.5% of your adjusted gross income. So our taxes capped at $10,000, mortgage interest on the first $750,000. Home equity credit lines are still deductible as long as this is a recent change again too, as long as the home equity credit line was used to do repairs and maintenance to your home, your personal home. Charity is still deductible, and don't forget to use for your RMD for an IRA. If you're somebody like that is pretty generous to your charity, use the rollover from your from your IRA to the charity using that rollover up to $100,000 because it fulfills the RMD and it makes it not taxable.
And
and then miscellaneous itemized deductions are out except for gambling and casualties are still deductible as long as it's a publicly declared disaster.
And don't forget, if you're single, or maybe in this case that gentleman is head of household, it's easier to achieve that new, to jump over that standard deduction if you're single or head of household. So want to pay attention to that. What
Right.
were we going to say,
Right.
Chris?
Well, besides braces, trying to hit the hurdle of the 7.5%, which that should, if he's paying for his own health insurance through the exchange, that's a deduction. If he has long-term care insurance, that's part of medical on the federal and a credit on New York State.
And it carries forward too.
And that carries forward. You have your regular doctor visits, your co-pays, your lab fees, your emergency rooms, your hospitals, maybe hearing aids, medical improvements to your home to help a disabled person get around in their house.
Did you say
there's-
long-term care
The
insurance?
elevator, one of those, those chairs you sit on and ride up the stairs. If you're unable to, again, you need the doctor to prescribe it. But anything that you do to help alleviate a medical problem, maybe you got a bad back and they said for you to get one of those beds that move all over, that would be deductible. So all of those things and your medical mileage, right?
Yep. Don't forget that.
Glasses.
I can't forget to tell you guys, I can't tell you how many mistakes I find for self-employed people who forget to take the health insurance deduction
adjustment.
as an adjustment to income on the first page of the 1040. So just a little side note there.
Right.
I've amended many of the
Okay,
returns
what
for
else we
that.
got here, Chris?
Ben writes in, Esther, I was in a car accident and my lawyer said that I will be getting a settlement soon. He said I should consult my tax person to see how much money to put aside to pay taxes next year. Can you help me?
Well, if it's
Well,
for
it's confusing to me because a car accident would usually mean there's
suffering.
pain and suffering. If it's wage continuation, then it's going to be taxable. But if it's for pain and suffering, personal injury is not taxable. So I think what Ben needs to do is clarify it with his attorney. Maybe his attorney was speaking out of turn. But if it's for pain and suffering or personal injury, it's not going to be taxable.
Right. I mean, but let's give the lawyer credit. At least he said consult your tax person.
Well, that's true.
But there's depending what the lawsuit is for, there it could be taxable. Like you said, this was probably pain and suffering, may not be. But if it was maybe you sued an employer for age discrimination and they had to pay you wages, that's taxable. Could be a sexual harassment lawsuit at the workplace. That could be taxable. I mean, so any type of settlement you have, call us and we can go through it. I mean, Social Security, that took 3 years to finally get, that could be taxable depending on your income for those prior 3 years.
But this is a great opportunity to use that extra money that you have to, even though it might be taxable on the right-hand side, on the left-hand side, you might be able to create a deduction by using an IRA as a deduction.
I was
So
thinking
you
that.
might be able to use it to put $6,500 away in an IRA. So if you had $10,000 on the right-hand side, but you put $6,500 of it away in an IRA, well, then much less of it can be taxed,
that's right.
right?
Yep.
All right, what do
And
we
then
got
don't
here
forget,
before?
hey, don't forget if you get, Chris mentioned Social Security, if you finally get the large amount of Social Security for disability Social Security, don't forget the potential of doing a lump sum election. And so make sure you pay attention to that.
Right, so explain what that would be, Tiff.
So a lump sum election is, say you get like $60,000 of Social Security, and some of it is payable for 2014, 15, 16, and 17. With a lump sum election, you're allocating the portions that are paid for those other years in those other years, so as to see if your income was lower and it would have behooved you more to claim the Social Security in those lower income years than the year that you actually received it. So you're actually spreading the taxability of that Social Security
So,
out.
so let's say you had 20,014, 20,015, 20,016, which is 60,000. But that 20,000, if that was your only source of income because you were so poor, it's not going to cost you anything,
Right.
because when you go back to those years, that would have been zero taxability, and that's what the lump sum election does.
And you know, we talk about tax changes and impacting it. You know, with Social Security, with someone getting this lump sum, there's a lot of changes there that just happened because you could have your lawyer fee that you had to pay a lawyer to get your Social Security of $6,000.
Not anymore.
Not deductible anymore.
Yeah,
Your
that's a-
workman's
that's
comp.
a shame.
Yep. Your workman's comp offset, not deductible anymore.
Yep.
So these people may have to pay tax on like $70,000 worth of Social Security, even though technically they only received $30,000, but they still have to pay tax because that deduction isn't there anymore to help them.
But this I want to say because I'm thinking that when they write the regulations, they're going to say, no, like gambling, we're going to let this in. Because it just would be a travesty if somebody is sick and getting Social Security disability and the attorney took 30%, that they wouldn't allow that to be deductible. So we'll let you know as soon as the regs come up. But right now it's still up in the air.
And I've got a question really quick. Bill from Williamsville. We are looking to retire in 2 years. We only have an IRA worth $150,000 and Social Security. Should we roll over the $150,000 into a Roth?
No, I mean, that's what people have to understand, that once you're retired, the first $28,000 in income that you get, not counting your Social Security, is not going to be taxed. So if you pay the $150,000, rolling over the $150,000 right now, you're going to pay about $33,000 to roll it over. You're paying this taxes up front, and it was never going to be deductible. So before you do something that you will really regret at tax time, give EG Tax a call. We don't charge to help you, and if you can't tell, we care.
Yep. And
I
then
mean, we care.
don't forget, we'll let you know about the first annual tax and financial seminar coming up and our summer series.
Right. But during the week, if you need us, give us a call at 632-7886. Visit us online at egtax.com. Until next week, I'm Esther Golias with Tiffany Fabian, Christopher Fabian. Have a great week. Thanks for listening. Bye-bye.